So one of the world's most powerful and secretive trading firms has just been banned from Indian markets.
SEBI has accused Jane Street of making illegal profits from its manipulative strategies.
In February of this year, it was found that prima facie the Jane Street Group appeared to be engaging in activities which were in violation of the SEBI regulations.
SEBI has identified 18 trading sessions, 15 involving Bank Nifty, 3 involving Nifty 50. SEBI has also impounded 4,843 crore rupees by freezing Jane Street's accounts, marking one of SEBI's most aggressive actions against a foreign firm.
This comes when a SEBI order had mentioned that 9 out of 10 F&O traders lose money in the derivatives market.
Jane Street, in a statement, says they're disputing these findings.
Jane Street is a Wall Street behemoth that built its fortune on hyperfast algorithms, razor-thin margins, and moves so stealthy they barely leave footprints. But this time, it did leave some, and SEBI, India's markets regulator, did not like what it saw. Here's my colleague and ET's finance guru, Sugata Ghosh.
What comes across, at least from the SEBI report, is a very old-fashioned market manipulation strategy, where the companies of Jane Street in India were used to manipulate or to rig up the prices and create the volatility, the right price points for the overseas entities to make money.
And this is big money. Over 43,000 crore rupees made via, allegedly, market manipulation. And this is what has led SEBI to take its toughest action yet on a global trading company. So, in this episode, we try to answer, what exactly is Jane Street and how did it become such a trading powerhouse? What alerted SEBI to Jane Street's market tricks? How it probed the alleged manipulation and why it took such a hard stance? How will the case pan out? And of course, will it set a precedent for India's algo trading? Listen on, it's Tuesday, the 8th of July. I'm your host Anirban Chowdhury. This is the Morning Brief. Now, Jane Street Capital is not a name you would find splashed on billboards. But behind closed doors on Wall Street, it's respected, feared, and rarely understood. Founded in 2000 by Tim Reynolds, Rob Granieri, and a small group of math and physics nerds, Jane Street was born out of a simple idea. Take the brain power of academia and plug it into the markets. Interestingly, one of their early hires was Sam Bankman-Fried, long before he launched the now defunct FTX. Now, Jane Street is what the finance world calls a proprietary trading firm, meaning it trades using its own money, not yours or mine. It's also one of the largest liquidity providers in the world, moving trillions of dollars globally. In the US, it dominates the ETF, or exchange-traded funds market, and is a giant in something called high-frequency trading, which is done in milliseconds. Now, what sets Jane Street apart is its algorithmic muscle. This has helped the firm stay ahead in a world which is increasingly becoming about who can process data the fastest. And the firm is said to operate with the confidentiality of a secret intellectual cult. No press interviews, no flashy offices. Its people, a congregation of stock market nerds, are known for intense internal quizzes, logic puzzles, and of course, zero social media footprints. Now, India has been a critical market for Jane Street. Why? Because its financial markets are at a digital inflection point. SEBI's regulatory clarity, growing derivatives volumes, and a maturing retail investor base make it an attractive playground for algo traders. So, Jane Street entered India quietly, like it always does, registering as a foreign portfolio investor or FPI and setting up code-driven operations. But then came the crackdown. On July 4th, SEBI hit the pause button on the firm's India operations. SEBI's main focus is the Bank Nifty index, which tracks 12 largest banks in India. SEBI says Jane Street used massive derivative trades to move that index's price. Imagine the stock index as a balance scale. So Jane Street is accused of loading huge weights on one side in the morning and the other side at the end of the day to tilt the balance exactly where it suited their bets. SEBI's interim order reveals that Jane Street made rupees 43,289 crore profit in index options between Jan 2023 and March 2025 versus 7,687 crore rupees in losses on futures or cash. The probe targets 4 Jane Street entities: JSI Investments and JSI 2 Investments that are India registered, plus Jane Street Singapore and Jane Street Asia Trading that is based in Hong Kong. The order says that the Indian arms would place intraday trades while the offshore FPIs held large option positions. Here's Mayank Bansal, president of a Dubai-based hedge fund who had alerted the SEBI of Jane Street's alleged manipulation.
So, I have been trading options since over a decade and a half now. And to any seasoned market participant, in January 2024 itself, it was pretty evident that the options in Indian indices were getting manipulated. So it was fairly obvious from the market dynamics itself. Basically, the equity markets has two parts, the derivative side and the cash side. Now, Indian derivatives market is extremely liquid, while the exposure required to move the cash market is not as high. Now, there were two types of expiries that were constructed. The first being a quiet expiry, which was type 1. The second being a volatile expiry. In a quiet expiry, the manipulating entity, which as per SEBI is now Jane Street, would sell options heavily, close to the money options. They would sell it heavily. As a result, options would become very cheap. Cheap to the point, it's like a real estate selling for, which typically sells for in crores, selling for, let's say, 20,000 rupees. Market would be maintained in an extremely tight range, meaning it would not be allowed to move by the manipulator who sold the options. So this was the quiet expiry construct. The volatile expiry construct, which is the second construct, is where the manipulator would pick a side, let's say the upside. In such a case, he would buy calls. He would buy calls in absolute complete bulk, which would make the options very, very expensive and make the market participants ponder as to why someone would be buying options at these exorbitantly, absolutely crazy expensive prices. And once he had bought the calls and established his options positions, till 1 o'clock, then from 1 to 3:30, he would move the market. He would move the underlying by buying the cash segment, heavily, such that all those calls that he had bought, which profit from a steep up move, would end heavily profitable. And he would make a killing on those calls. So these market dynamics actually were very unusual and highly fraught with discrepancies, which alerted not only me, but a lot of other market participants as well.
Understood. Then what did you do after that?
So January 2024, I had observed this and I was convinced it is manipulation then itself, which is 1.5 years back. The extent of manipulation just kept increasing through the year. It is at that point when I reached out to SEBI. On 17th of December 2024 is when I sent a mail to SEBI attaching an extremely elaborate and detailed presentation on the different expiries and how they were being manipulated. So once I reached out to them in December 2024 and I gave the presentation, SEBI started investigating this and they sent a caution letter in February to Jane Street. And post the sending of the caution letter, it's very interesting to note that the manipulation actually stopped from 5th February 2024 all the way up till 26th March 2024. But from 27th of March, he resumed the manipulation. And it is at this point that SEBI had also released a set of measures called intraday gross and net delta exposure limits, which were designed specifically to prevent this manipulation from happening. NSE had also at its end conducted an investigation, mid of last year, and its surveillance revealed nothing, which is quite sad. So SEBI had to intervene, and now Anant Narayan has released the order. So this is the sequence.
Of course, SEBI had been tracking this for a while. Here's my colleague, Reena Zachariah, It is hawk eye tracker of Indian markets regulatory developments.
So, see, there are multiple trigger points for SEBI. Firstly, in Jan 2023, SEBI came out with a report wherein they said that, retail investors were losing money in derivatives market. The study pointed out that 9 out of 10 traders in equity F&O segment incurred an average loss of 1.1 lakh during FY 2022. So this was published in 2023, January. Now, after that, SEBI started, getting complaints as well from market participants that something wrong is happening in the F&O segment. And eventually, as they started continuing with their study, they looked at the index options segment where, a lot of activity was happening towards the expiry day. And specifically towards the last 2 hours of the expiry day, a lot of activity was happening. So they looked at 3 segments actually in the F&O space. They looked at FPI, proprietary trading, and retail investors. And they saw that retail investors were continuously losing money in the option segment, while FPI and prop traders, they were making money. Specifically, FPIs in the large chunk was making money. Of that, they said that specifically one entity was making huge sum of money. In the meantime, what happened was last year in April 2024, there was this media report that a dispute over Jane Street's proprietary trading technology with its rival Millennium Management in the US. So the case landed in the New York court, where Jane Street declared that 2 of its traders, ex-employees, had stolen its strategy when they moved to Millennium. And it said that the strategy had yielded them 1 billion in profit, which was deployed only in the Indian derivatives market in 2023. So these are various trigger points, various factors actually, which they had to piece together to come to these findings.
So, Reena, has SEBI ever come across something like this before?
So, see, this is probably SEBI's first case in algo trading, because algo trading was not done on such a large scale. So this is probably first time, but we must understand there is a background on how SEBI was able to actually crack this case. SEBI always used traditional methodology like examining trade log, order log to investigate its cases of securities law violation. But that was not capturing this particular manipulation properly. So they were not able to find this out, but they had to change their whole mechanism to figure this out. Like they had to look at probably minute by minute the data, the delta, to look at basically how this manipulation was being done, because these are like highly sophisticated software which was used to do the manipulation actually. So they had to change the way they were looking at these data and basically change the team, re-examine the whole matter to basically get a headway into how this whole thing worked.
How much time did that take?
See, we could probably say April 2024, SEBI actually began its investigation. It asked NSE to look into it because NSE has a largest volume in terms of in the derivative segment. So NSE looked into it and submitted its report to SEBI. And that is how the whole thing started.
Now, it seems like a really complex story. But Sugata, my colleague you heard at the beginning of the episode, says that the trick at the core is really simple.
Well, if you set aside the technology, the complex algorithm, the use of multiple vehicles across jurisdictions, as well as this elaborate arrangement, what comes across, at least from the SEBI report, is a very old-fashioned market manipulation strategy, where the arms of Jane Street, the companies of Jane Street in India, were used to manipulate or to rig up the prices and create the volatility, the right price points for the overseas entities to make money. It's as simple as that. So the overseas entities, that is the FPIs, the foreign portfolio investors which are registered with SEBI in Hong Kong and Singapore, they were taking huge options positions. And the options and futures, they are settled by the underlying equity prices. So the job of the local entities, that is the Jane Street entities in India, were to take the equity prices, to move the equity prices in a way where the overseas arms end up making profit. So in the process, the local entities may end up making a little loss. But that doesn't matter because the Singapore entity is making huge gains. The Hong Kong entity is making huge gains. Now, there is a great tax arbitrage that is happening here because in India, F&O's gains, that is the futures and options, the equity derivative gains, are taxed at the full income tax. That is at 30%. If you're a company, it will be taxed at 25, a little over 25%. But when an FPI from Mauritius or Singapore, the countries which have double taxation avoidance agreements with India, there the F&O gains are not taxed at all. It's zero tax. So most of the profits are being recorded in jurisdictions where there is no tax. And smaller profits or even losses are being parked in India where you have to pay tax. And you end up paying very little tax or no tax.
Right. Tell me, how does the GAR or General Anti-Avoidance Rule come into play in the story?
Well, the General Anti-Avoidance Rule is largely associated with shell structures. That is, you lack substance. That is, if an FPI has set up an outfit in Mauritius or Singapore simply to fish for tax gains, the taxman can question, right? But here, this is not the case. Here, the question is not of substance, because I'm sure Jane Street has good presence. It has an office, it has employees, it has analysts in Singapore as well as Hong Kong. So it has a substance. It's not a paper company or a shell company in either Singapore or Hong Kong. If GAR has to be invoked, and I strongly feel the income tax authorities will do it, it will be on another clause under GAR, which says that if the arrangements and the trades have happened in a manner which are not ordinarily employed for bona fide purposes. You have set up these huge arrangements, multiple arrangements, and you are carrying out trades which you wouldn't have done for ordinary purposes, for bona fide purposes. For a genuine trade, that's not how it happens. If the income tax authorities can establish that, I think that is where the tax authorities would be harping on.
Understood. Now, Sugata, this so-called artificial arrangement that has been identified by tax authorities, how can they build a case on this?
Well, it is for the market regulator as well as for the income tax authorities. If they can link that the two sets of trades were absolutely mirror trades, where the Indian entities were carrying out transactions which were entirely meant for the foreign entities to make money. In that case, the market regulator as well as in the income tax department, they have a point. In that case, they would say that, look, this entire arrangement was primarily to dodge tax. And secondly, if they get cooperation from the Singapore authorities to find out whether this money which went to Singapore was entirely routed to or transferred to US, then they can raise the issue also that the Singapore was only a pass-through vehicle.
Now, the big question is, does SEBI have a good case? And also, what would be Jane Street's defense?
Well, I feel SEBI does have a case, but if you see the SEBI regulations of the prevention of fraudulent practices, trade practices of 2003, it's entirely built on intent. If your intent is wrong, then even if you have followed the letter of the law, but you have just demolished the spirit of the law, there can be some elbow room for SEBI to come after you. Jane Street may well say that, look, we have employed algo, which are program-driven trades. There is no human intervention happening. You can't blame us. But that is not true because SEBI had more than once warned Jane Street that you fix your arrangement, you mend your ways. But they ignored that, right? So there is some room for SEBI to build a case. We'll have to wait for the final order.
I went back to Reena with two questions. Now, Reena, this is, correct me if I'm wrong, but this is described as one of SEBI's toughest actions in the last many, many years. How might this set a precedent for algo trading oversight in the near future?
See, this is considered the toughest punitive action for two reasons. One is, an international trader of this size has never been penalized by SEBI or barred from the market, especially a foreign trader. Secondly, the impounding of over 4,000 crore. This is probably the largest impounding order by SEBI passed against any entity till date. So, in that sense of it, this is definitely one of the toughest action against a market participant. Secondly, this order will set precedents because we must understand that SEBI's order does not provide any evidence of any information being shared or any communication proof between any entities which can be said that there was a fraudulent act involved over here. This is purely finding fault with Jane Street's strategy. Jane Street is known for its market making, and Indian rules allow market participants to take contrary positions in the cash market and derivatives market. Jane Street has done whatever it has done within the regulatory framework that is provided in India. Now, SEBI's point is basically that the kind of large scale volume, the profit that they made, and the kind of activity towards the last few hours of the expiry and dumping it towards the end of it is something which they have basically found fault with the whole strategy which they have engaged with in the Indian markets. Now, definitely courts have to basically clarify whether these kind of strategies are wrong or, because of human element over here of so many investors, small investors losing money. So in that sense, this will definitely be a case first of its kind, maybe going up to the Supreme Court.
Understood. And of course, Jane Street has disputed the findings. What do you think will be the other potential outcomes of this case? Could the ban be lifted or penalties reduced?
See, the ban on Jane Street is till such time that they deposit the money, the profits that they have made, which is some 4,000 odd crore into a bank in India. The moment they deposit the money, the ban could be lifted because this is not a permanent ban on Jane Street. And they have 21 days to even reply to the SEBI's interim order. Jane Street has told us that they dispute SEBI's order for the simple reason that their whole point is basically they have engaged in strategy. They have not done anything which is illegal or which the Indian laws does not permit them to do.
I asked Sugata for the final word on how he sees this saga unfolding.
Well, I believe this would be a very long haul because there are fundamental and complex questions in this entire thing. That how SEBI builds this case. SEBI doesn't particularly have a stellar record in winning cases. But after the final order, we are certain that Jane Street would move the appellate authority, Securities Appellate Tribunal. And I'll not be surprised at all if it goes to higher courts, even up to Supreme Court. So this, because here is a case which will dwell on multiple questions. The use of algo, human interventions, why were the instructions of SEBI ignored? Why when the algorithm, the program changed? And how exactly do you link the two sets of trades to build your case of manipulation? So I'm 100% sure this will be a widely tracked case. If you see in the last 1.5, 2 years, a lot of foreign investors, foreign institutional investors, they have set up wholly owned subsidiaries in India. Now, when you set up wholly owned subsidiaries in India as prop brokers, the way this Jane Street 1 and Jane Street, the Indian outfits were operating, they're prop brokers, right? Now, these prop brokerages have come up because they can do trades which FPIs cannot. For instance, intraday positions or have a greater latitude in FNO positions. That is a very good explanation why they want to do business here. But I think I won't be surprised if SEBI sees or SEBI goes through the books or the mechanisms of other prop brokers, other foreign outfits, on whether they have indulged in similar manipulative trades. That is what SEBI finds manipulative.
Right. Thanks, Sugata, for joining us.
Thanks.
Jane Street's India ban is a signal that stealth and speed won't override scrutiny. As India's markets digitize and deepen, the rules of the game are getting sharper, and so are the referees. In fact, SEBI chief Tushar Kanta Pandey on Monday said that it is planning to enhance its surveillance system to check manipulation in the derivatives market. For global quant giants, it's no longer just about beating the market, it's about playing fair in it. That's it for today. This episode was produced by me, Vinay Joshi and Radhas Naik, sound designed by Indranil Bhattacharjee. Listen to The Morning Brief every Tuesday, Thursday and Friday, wherever you get your podcasts. All external clips used in this episode belong to their respective owners. Credits are mentioned in the description.